If you've been invested in the stock market over the last 15 years, your portfolio has probably done very well. The S&P 500 delivered strong, sustained gains, fueled by tech growth, low interest rates, and economic recovery. For many investors, stocks quietly became a much larger part of their portfolio than originally intended. And that's exactly the issue. When markets rise, portfolios change. When markets rise for a long period, portfolios often become unbalanced without anyone realizing it. What started as a reasonable mix of stocks and conservative assets, like bonds or cash, may now be far more aggressive than appropriate for someone who is retired or close to it. Because retirement is a different phase of life. Retirement changes the goal. Before retirement, growth is the main goal. You have decades to recover from downturns. But in retirement, the priorities change dramatically. Now the goals are reliable income to cover living expenses, protection from large market losses, stability during down markets, long-term sustainability, not just growth. In this phase of life, asset allocation becomes more important than market returns. Markets move in cycle. When people talk about the stock market, they're usually referring to the S&P 500. Over the last 15 years it has been strong, but history shows returns are not consistent every decade. From 2000 to 2010, the market experienced two major crashes and long periods of little growth, often called the lost decade. The next 10 years may look nothing like the last 10, and retirement planning has to account for what could happen, not just what recently happened. This chart shows how the S&P 500 has performed across different decades. Some periods saw very strong growth, while others had little or even negative returns. For retirees, this highlights an important point. The market moves in cycles, so retirement planning shouldn't rely only on recent strong performance. A balanced plan helps prepare for both good markets and difficult ones. Why rebalancing matters. After a long bull market, many retirees unknowingly hold too much stock risk. The danger isn't just a market drop, it's when that drop happens. A major decline early in retirement, while you're withdrawing income, can permanently damage a portfolio. This is known as sequence of returns risk, and it's one of the biggest threats retirees face. Without proper allocation, withdrawals may lock in losses, income may become unstable, portfolios may struggle to recover. The bottom line, the last 15 years in the S&P 500 have been strong. But retirement planning can't assume the future will look like the recent past. Retirement is about balance, not chasing returns. Proper asset allocation helps reduce risk, support reliable income, protect against market volatility, help ensure your money lasts as long as you do. Because in retirement, how you allocate your assets matters more than how the market performs.